All right, welcome to Talk Tickers. Today, we're tearing into Opendoor's fourth quarter 2025 earnings call. And let me tell you, this was a report that was way less about the simple numbers and way more about management saying things are different now. Let's get into it. And really, this whole story kicks off with this pretty gutsy statement from the CEO. He basically took that classic warning for investors and flipped it on its head. He framed this whole quarter not as a bunch of promises, but as proof. A moment to show everyone the turnaround is for real. Okay, so here's the game plan for how we're going to break this all down. We'll start with the headline numbers, then we'll dive into what they're calling the Opendoor 2.0 strategy. After that, we'll look at the proof points, see how the market reacted, and then, of course, we'll make our next call.
All right, first up, let's get right into the headline numbers. How did Opendoor actually do compared to what Wall Street was expecting? So right off the bat, these numbers are kind of weird. You've got two totally different stories playing out here. On one hand, you have this massive revenue beat, $142 million more than expected. That's huge. But then you see this jarring GAAP earnings miss of over $1 per share. The real key, though, it's that adjusted number. Once you strip out some of the accounting noise, they actually beat expectations. And that right there set up the central conflict of this whole report. And this, right here, this really lays out those two competing narratives perfectly. The bad news column looks pretty scary, right? That huge GAAP loss was mostly from a non-cash charge, and yeah, revenue is still down over 30% from a year ago. But the good news column is what got investors excited. Big beats where it counts, backed by some really strong signs in their day-to-day business operations. So the big question is, which story won, the bad accounting news or the good operational news? Well, investors made their choice loud and clear. The stock absolutely ripped higher, surging 17% after hours. The market was basically shouting that it believes in the turnaround, not the messy one-time accounting stuff. Okay, so that brings us to the how. How are they pulling off this turnaround? Well, it all boils down to this new playbook they keep talking about, Opendoor 2.0. So what is Opendoor 2.0? In plain English, it's a huge shift away from that old grow-at-any-cost mindset. The new game is all about being nimble. It means holding fewer homes, selling them a lot faster, and using less of their own cash to do it, all while making sure each group or cohort of homes they buy is profitable. It's about quality over quantity. And look, they aren't being vague about this. They've laid out a super clear 4-step plan for everyone to follow. First, stop losing money by the end of 2026. Second, make a profit on each house while also selling them faster. Third, cut out the middlemen and work directly with customers. And fourth, the big vision, become a platform where people can buy and sell directly from each other, which would slash Opendoor's own risk. All right, so a plan is just a plan, right? The million-dollar question is any of this actually working, or is it just a fancy slide deck? Well, management came prepared with what they call proof points. Let's look at the data. You know, management was really banging the drum on this one. They kept pointing to one specific thing, the group of homes they bought back in October 2025. This was the very first batch acquired completely under this new Opendoor 2.0 model, and they're claiming it's on track to be the most profitable October cohort in their entire history. That, they said, isn't a plan, it's a proof point. And wow, this chart right here, this is the leaner part of the strategy in action. Just look at that dramatic drop in how many homes they're holding. They cut their inventory by more than half in just a single year. That's a huge deal. It means less money is tied up in houses just sitting there, and way less risk if the housing market gets choppy. And here's the other side of that coin, the faster turning part. Even though they're running leaner, they're actually buying more homes again, up 46% just from last quarter. They're selling them faster too, cutting the average hold time by 23%. And this is critical. The amount of old, stale inventory they have has dropped from over half to just a third. And that famous October cohort, it sold twice as fast as the one from the year before. That's what execution looks like. Okay, so let's put it all together. You've got this ugly headline loss on one side and all this fantastic operational data on the other. How on earth did the market react so positively and cheer on what looked like a big loss? You know, this timeline really tells the whole story. At market close, the stock was just sitting there. Then at 4:05, the messy numbers drop, and still not much happens.
But then the earnings call starts. As management starts explaining the strategy, laying out those proof points, the stock just starts to climb and climb and climb, peaking at a 17% gain. Investors listened. They got the story behind the numbers and they bought in. And it wasn't just retail investors getting excited. For the most part, Wall Street analysts were on board too. The general vibe became cautiously bullish. They gave the company credit for the great execution, but were also quick to point out that it's not going to be a smooth ride. There are still hurdles like selling off the last of that old inventory. The main takeaway was, progress is real, but don't expect a straight line up. All right, let's wrap this up and get to the part you've been waiting for, the next call. Based on everything we just heard and saw, what should we be expecting from Opendoor from here on out? So yeah, that's the big question on everyone's mind now, right? After that big pop, is all the good news already baked into the stock price, or is there still more upside here? So here's our prediction for the next quarter. It's all about margins, not so much about volume. Management themselves guided for revenue to dip a bit as they stay disciplined. But, and this is a big but, they also guided for their contribution margin, which is the direct profit on each sale, to be the highest it's been since mid-2024. They're choosing profitability over growth right now, and we think the numbers will show that. And what about the stock price itself? Well, we think it's going to be a choppy path, but ultimately to higher ground. You're going to see this constant tug of war between macro fears, like interest rates, and the company's solid execution on their plan. So expect some volatility, but as long as they keep delivering, the underlying trend should be positive. Okay, so that brings us to our final reading. For the next call, we're rating Opendoor a market perform. Now, this isn't a call to sell, and it's not a screaming buy either. It really reflects the current balance. The operational improvements are absolutely real, and they've de-risked the business in a big way. But the macroeconomy is still a huge question mark, and they have to prove they can scale this new, disciplined model. The story is good, but the external risks keep it from an outperform reading, at least for now. And of course, we have to end with this very important reminder. This analysis is for informational purposes only. This is not financial advice.